No problems. We'll come to George and come to you. Hi, everyone, and welcome to today's market analysis for Sunday the 3rd of July, 2022. It's great to have your company today. We have got Ainslie and George with us today. As you will have heard on the crossover, Ainslie having some technical issues. I don't know whether it's the internet. I don't know whether it's Zoom, but there's often a little technical glitch with Zoom. We've just come out of our breakout webinar, Learning to Trade breakouts with Ainslie, which many of you would have been in. Now, she has been out. She has come back in. I'll just see as she comes back in. She'll be on sound, I would think, in about 5 or 10 seconds. If she is, we'll stay with the original plan and go with oil first. And if she's not quite ready, we will go with George first. Ainslie, where are you up to? Going to give her another 5 seconds. Ainslie, you around?
I'm good.
Ainslie, are you ready to go with oil? Or do you want me to go with George first?
I can go with gold.
Okay.
Gold.
Okay. I'll do a bit of a run into it, okay, so we can have a full recording. Hey, everyone. First of all, welcome to everyone. Nice to see so many in the Zoom room. It's good to have your company on a Sunday afternoon as ever, and a busy Sunday afternoon for Actions 12 staff. We have got meetings coming after this. We're going to get into this market with one of those ones that we've been waiting for a little while, seasonality coming into play here, and we are looking for a move on gold not too far away, I would think. Ainslie, what's your read? Is this move in gold likely to turn up?
Look, at the moment, it's a really hard one to call because let's have going to go straight over to, oopsies. All right, hang on, which one? Let me just stop sharing. Sorry, I just grab the screen, grab the right one, and we'll go from there. Okay, so we've got gold analysis for this week. We saw gold drift down. Okay, we've got a lot of there was a lot of erratic spurts up and down, sideways, but overall it drifted down. But Friday we saw this major move back up again, and we're closed at 1809.22. So Friday's action was the only thing that we saw that was of any interest. Where it unfortunately just reversed exactly what it was doing. That was off the back of the US dollar taking a move lower. It was very interesting after seeing the US dollar push up, and that was on the higher timeframes. It's clearly visible. There is now a pause in the downtrend. Okay, so even though we had that move up on the higher timeframes on the weekly and the monthly, we're still just going nowhere fast. So what does that look like on the charts? So this is on the 4-hourly, and it was erratic. You can see, Paul, it was just all over the place. It up, it was down, and then it finally drifted down. And then we had this major reversal with this low test bar, and it came back up again. And when you look at it on a daily chart, bang, you're straight back into that box of consolidation. You're back into an area, back into the range. However, where it's going to go to from there. I mean, I love a low test bar, but I love to see another bar to bring it back up. Is it going to go back to the top of the consolidation box, or is it going to come back down and drift a little bit lower? That's really hard. But if we're going to look forward, we need to take a few more things into consideration. You're looking at now on a weekly chart. It looks dead. You know, gold just looks dead. One of the things we like about dead and consolidation and ranges is it's going to break at some point, isn't it? It's going to go to the top side or it's going to go to the bottom side. Seasonality should be having a little bit of a push behind it, but at the moment, one of the big overlying factor on that one for me, Paul, is the Fed. Now, there's been a lot of lurking sentiment that the Fed Reserve has left their action plan to address inflation just a bit too late. It's not, where that has the impact there is that it's going to be aggressive with hiking those interest rates. Those interest rates go up, so do the bond yields. Bond yields are really affecting there's an inverse relation. So real bond yields, as they're going up and people taking money out of the market, is being a lot more attractive. As attractive as 3, 4, 5% can be, it's still impacting where gold is going. And I know we've got that seasonality factor going on, but the fundamentals at the moment is really, really, really strong. So that's one of the reasons I think we're still in this horrible sideways movement with no direction. But hey, I like a good seasonal move, and it's not happening. I've missed out on a couple of seasonal moves just lately, and it's just not been a lot of fun. So just to give you an idea of what that is looking like at the moment, there's your 10-year real bond rate, and there's gold. It's just ugly, isn't it? It's just, oh, never mind. Anyway, that's what we've got. That's what we're dealing with, and we've got to deal with what we've got before we can make a move. The week beginning 4th of July, we have Monday, the markets are closed for American Independence Day. The big one this week will be obviously the non-farm payrolls on Friday. But at the moment, I don't see any major events pushing gold higher. I'm looking for them. Trust me, I'm looking for them. But I'm expecting more consolidation, and possibly if there is more talk and more Fed sentiment that they're going to be aggressive because they've left their run a bit late, we're going to see those yields go up a bit more, which is going to put a downward pressure, unfortunately, on gold. That's my take on it at the moment. You're muted, Paul.
Fascinating what we look at, isn't it? We've got 10-year bond yields at rates which people like you and me would still start to look at as being ridiculously low, and the whole generation behind us have never seen them this high. It's quite a different world we're living in now than the one we lived in perhaps 20 or 30 years ago, and we might be coming back to something like we saw in our day. Thanks for the analysis. Really interesting. I think that 10-year bond